Good evening. Ira Epstein with your Metal Market Wrap-Up. And this wrap-up is for Wednesday. And we are now at the 2nd of February, 2022, in the midst of a great storm in the center of the United States that's sweeping through the country. I can tell you in the city of Chicago, we have about 8 inches of snow in the city. That's unusual. You move out, you got about 12 inches, and there's another storm coming right behind us. We're getting a little respite now, then it'll go. We're used to this. We used to have this years ago. We haven't had it year after year, but it's, we get tied up and then you move on. In the markets, you're moving on from what? That becomes the big question. If you look behind me, the stock market down, this is a reaction to Facebook earnings, which came in as a big miss, and the market drove right down. But we're talking here about metals, and what the metals are doing is this. In fact, market after market is doing something like that. Let me explain what happened. As we all know, January was a hellacious month in that you took out value out of the stock market in a massive manner. The market got enamored, as you know, with the idea of many rate hikes coming. We had a huge miss today in the ADP numbers, but ADP is volatile. It's not always the best indicator of what the job market looks like, but we did see jolts, and that wasn't the best of numbers you could have had. So now this tells us where are we going on Friday. Then we have the Bank of England, monetary policy, the European Central Bank, and a whole series of CPI numbers coming. What I'm getting at here is we dove down, we rallied vertically, straight up again, made back close to 30% or so of the losses, because some markets a little more, and now you seem to be stalling. That's the point. I'll cover a lot of that in detail in the financial review of the video. Suffice to say, in the metals, gold has been a disappointing market, and that's the lead metal, but I like copper still. I like it a lot, actually. I like the platinum, the palladium markets. Are they ready for purchases? Well, let's talk about that. Gold is stuck at the 18, and this is a weekly chart of only closing prices. It is stuck against the 18-week average of closes. It's up for the week going into Thursday, $21 off the lows of where it closed last week, but that just puts it back at this 18-week average. You're either side of it going in the midst of nowhere right now. When we look at an April chart of gold, you went from this near 1860 level down under 1785 back to 1807. So you had a huge drop. You've made back maybe 25-30% of that. When you take a look at the action on the swing line, you had an outside day, and I'm going to come over today to this, an outside day to the upside. One of my chart rules is you should not take that low out for the next 2 days, and if you do, what happens is the market puts into play getting back to the closest of a moving average under the market or a Bollinger Band. Well, the moving averages, if you take that out, you'll be under all the averages anyways, and that would put into play the lower Bollinger back at the 1781.30 level. Doesn't mean that I'll be right in my analysis, but I like the probabilities when that happens. So let's assume the market, and I'm going to come back here just a little bit to the prior chart, wants to rally. The 200-day average is waiting for the market at 1810.90, and the 18-day average at 1820. As I said, the pattern is already one of higher lows, higher highs because of the outside day up. So the trend is up, but the bias is down since you're under the 18-week average of closes. And in terms of momentum, the market has worked out. It's no longer in an oversold condition. You have both these numbers back into the 30s, not with one leg into the 20s. It can go either way here. A close over 1820.10 will certainly get the attention of the bull trade, and they will then start talking. Maybe again we can get back to 1859. Maybe whatever the event that causes that isn't so bad. Obviously, everyone wants to see what the jobs data is going to look like, and I guarantee the Fed wants to see it too. When you look at the gold-silver ratio, you're stalled out at the 80-to-1 area, roughly. So basically, it is still favoring gold. Whenever you're over the 18-day average, it means silver's weaker than gold. Get under it, silver's a bit stronger than gold. And if you look at the silver market, the chart is bearish. lower highs, lower lows. Where the resistance comes in is the problem. To get up to the resistance point of 23.22 to 23.24, the 18 and the 100-day average of closes, you have to take out the prior high of 23.06. Well, that would give you higher lows under this scenario. Let's assume it just went up there, and higher highs. And frankly, if you then closed over 23.24, the buy signals would hit instantly. Why? You'd have higher lows, higher highs over that number, and at that point, stochastics might even turn up, so momentum would shift with the market, and traders would think that was it. Giving you all the scenarios, okay? I don't see the pros selling into this because where they'd probably want to sell be a problem for them. It changes the market pattern. In the copper market, you're really just trading sideways between the upper and lower bands. We know that the biggest user of copper's got their Golden Week holiday right now. The Chinese New Year, the Lunar New Year is taking place. Let it do its thing. You're going to see very shortly two good friends together at the Olympics, Putin and President Xi. Their relationship getting tighter and tighter because they look at America as the big enemy of the world. Okay, but that's what you're going to see. He'll be the big dignitary there. In the platinum market, you have lower highs, lower lows. So trend down, it's nullified because the market's over the 18-day average of closes. I teach that when you're over the 18-day average of closes, it's a filter. It's telling you, hey, the bigger money is on the bull side. This is a correction within that. Let's see where the market finds its support and can it turn itself back up. Obviously, the upper Bollinger Band area did its job. 95% of the time, you'll stay within those bands. That's what that did. You're also in the market here overbought. You have to have numbers of whether you use RSI, MACDs, slow stochastics, fast stochastics, where you can define what is an overbought, oversold condition, or the market's locking in trends. In this case, I define that as overbought. In the palladium market, I am still fully in the bull camp on every part of this. You have higher lows, you have higher highs, you have an embedded reading. You were going up on the right-hand side of the Bollinger Band on what we call a gorilla glue trade. What do I mean by that? It means that every single day, just look at this, you're hitting the Bollinger Band. See that? That's what I call the gorilla glue. Then it starts slipping away. That could be a sign of weakness. You got to be a little bit careful now. The smart money's been taking money as they're buying the breaks, selling into the Bollinger Band. But that's the type of runs that come out of getting very narrow in the band. The narrower the band goes, you got to think of it like a pressure cooker. It's in there, the steam's going, it's going to blow out one way or the other. It happened to go. And now what the market's doing is it seems to be caught temporarily with the 200-day average for the moment acting as support and the Bollinger Band as resistance. Should the market take out the lows of today, which were, what was that, 2303, the odds favor upon that. You probably get the red line to turn down, and that might set off a break back towards that 18-day average. I'm not saying it will happen. I'm giving the what-if scenario. In the dollar index, when we got up here, this is where everybody's super bullish, but I wasn't. I said, I think the pros are taking their money off the table. I said it right here. And it's overbought. It either embeds and tells us it's going to do something or whatever. Where do markets often return to figure what they're going to do next? The 18-day average of closes, what I call the line in the sand. That's exactly what's going on. So what the market is now doing is when it reopens tonight, and it hasn't opened yet, so we'll get the Thursday trade in a little bit, it will get out of an overbought condition. Because you dropped like this, the math will take it down unless you were to just jump up for some reason. But barring a normal opening, even near that price, you'll get both numbers away from the 70 level. So that's your support zone. Those that want to be bullish, their risk will be not getting back under 95.40 and a half. It's not a small risk. It's almost $530 from current prices per contract. And their objective would be up here. I think a lot of traders are going to say, you know, that's such a broad sweep, maybe we need to consolidate it. That would not surprise me in any manner. What you see me doing here, I do in our futures trading kit when I walk you through some basic ideas, teach you about the markets, give you access to our research. In the kit, access to our charting software programs. And within our charting software, you're able to see the daily news that we put out, commentaries that are oral, they're right there. If you keep your screen on and open with it, you'll hear broadcasts throughout the day of the news of the market, what's going on throughout the whole day. It's news built for futures traders, along with certain of my courses, my PowerPoint courses. Most of them are videos, so you'll know. And they will talk to you like pivot point, support, resistance. Where are they? What are the day traders doing in the market? I think you get a pretty good idea. Many of the courses that the Chicago Mercantile Exchange puts out, we link right to them, and they are free to you. So how do you get all this? Just go to our website, get this along with our other offers by going to free offers on the top part of the website. It's that simple. I'm Ira Epstein. You have a great trading day. I will see you all tomorrow.